FX markets are in the front line of Donald Trump's economic war, with the president seeming to be revelling in the problems that the strong dollar are causing his economic foes. This summer has seen a marked pickup in emerging market foreign exchange volatility, with the likes of the Turkish lira, the Russian rouble and the Chinese renminbi all under pressure, and they're all under varying degrees of US economic sanctions. And you can see that in this chart, which shows emerging market FX volatility, the grey line, and the orange line, which is developed market volatility. There was divergence earlier this year, but over the last few weeks that divergence has widened hugely. The US looks unlikely to change course on sanctions anytime soon. So what will the next few months look like? The US looks set to increase sanctions on China even further, potentially imposing a 25% levy on a whopping $200 billion worth of Chinese imports. These sanctions could go into effect in September. Additionally, the US is looking at a harsher set of measures against Russia, including for the first time looking at sanctions on the Russian sovereign bond market. It is certainly a challenging time for emerging market currencies. And despite the good domestic stories, we're a little worried that some of the big beasts in the emerging market space, the likes of the Polish zloty and the Mexican peso, that they get sucked into the trouble as well.